Good morning, everyone. I'm Greg Faranello, head of U.S. rates for AmeriVet Securities, and welcome to Monday Minutes. Extreme employment number on Friday. A lot of questions about classification, PPP versus unemployment insurance. We just don't know. Traditional economic models are not necessarily going to work in this environment. You look at the claims numbers in a traditional economic environment, and the predictive nature of those numbers are probably much more in line with what economists would expect. The reality is we've talked about a bottoming in the downside to the employment picture, and if anything, we think we have seen a bottoming of those numbers as of Friday. We look to numbers in brighter days ahead, but the reality is we still think the numbers will be uneven going forward. We look at the U6 rate on a monthly basis, that number is still above 20%. So we do think Friday's number is good, it's constructive, the country needed good news, but we need to keep it into perspective at this point. Looking ahead this week, obviously we've got the Fed, we've got Treasury supply, starting with 3-year supply, but more so long-end supply. We've seen global yield curve steepening across the board. We've seen Treasury yields, particularly in 10-year space in the long bond, break out of their recent ranges. We had a 55 to 80 basis point range in the 10-year note. We look at 95 as sort of a level here, and then obviously 120 is where we got to back in March. The reality is here, if you look at the first quarter of this year, you look at coronavirus, you look at the extreme move in Treasury yields to all-time lows, you look at the flight to quality trade that we've seen, many of those themes with the Fed, with the fiscal side of the equation, with the economy reopening, are reversing right now. So we had extreme move in Treasury yields, we had an extreme decline in oil, we had an extreme decline in equity valuations, we had an extreme widening in credit spreads. We're seeing that reverse now, and it all needs to be taken into context. It's all relative. The V-shape that we're seeing in financial markets doesn't necessarily mean that we're going to see a V-shape in the economy, but that's how we're trading right now. So when you look at treasuries in particular, why own 10-year notes at 55 basis points if the economy is recovering, the economy is reopening, and there are high-yielding assets to potentially invest in? And that's really the theme of what we're seeing right now. Obviously, positions matter in terms of where we got to heading into this point. But this week, we will get long-end Treasury supply with the market backing up and people questioning as the Fed pares down their asset purchases, where do long-end Treasury yields belong is the reality. And we will get a glimpse of that this week as we get 10-year supply and 30-year supply at some pretty key levels here. When we look at the Fed in general, we expect the Fed to stick to the script here. They're in the beginning stages of rolling out their lending facilities. Friday's number is not going to impact the Fed one iota in terms of laying off the gas here. Powell will be steadfast in his message. He'll likely talk about the Main Street lending facility. He'll likely talk about the municipal liquidity facility, which has already been tapped by the state of Illinois. And he's likely going to be questioned in terms of what additional tools does the Fed have here going forward, should they be needed as the economy reopens. And we just don't know where the economy will look 3 and 6 months from now. We've got a white paper out on AmeriVetSecurities.com talking about the updated balance sheet numbers with regard to the facilities, talking about some of the themes in between meetings, and obviously talking about the transpiration of events over the last 3 months. I'm Greg Faranello, and this is Monday Minutes.